Chapter 13. Loan capital and loan interest. Circulation of money. Loan capital emerges from idle money. Just as merchants specialize in commodity exchange, some capitalists specialize in lending out their temporarily unused money capital. This happens when businesses have surplus cash, example, depreciation funds, uneven revenue cycles. Mutual benefit for capitalists. Lending allows capitalists with surplus funds to earn interest, while borrowers can expand production and increase profits. Interest is a share of surplus value. The interest paid on loans ultimately comes from the surplus value generated by workers in the production process. Loan capital reflects capitalist relations. It highlights the relationship between money-lending capitalists and those actively using capital in production, industrialists, merchants. The illusion of money creating money. The movement of loan capital obscures the origin of profit in surplus value, making it seem like money itself magically generates more money. This reinforces the fetishism of capitalist relations. Separation of ownership and function. Loan capital exemplifies the separation between capital ownership and its use in production, further mystifying the source of profit. Interest and profit of enterprise. The rate of interest and its tendency to fall. Profit of enterprise is an illusion. While it appears to be a reward for the capitalist's managerial efforts, profit of enterprise is simply another portion of surplus value. Division of profit. The average profit generated in capitalist production is split between interest, for the money capitalist, and profit of enterprise, for the functioning capitalist. Interest rate fluctuations. The rate of interest, which is the ratio of interest to the loaned capital, depends on the supply and demand of loan capital. High demand leads to higher interest rates. Limits on interest rates. The average rate of profit generally acts as the upper limit for interest rates, as interest is ultimately derived from profit. Tendency for interest rates to fall. As capitalism develops, interest rates tend to decline due to the falling average rate of profit, which caps interest rates. The growth of loan capital exceeding demand, fueled by the rise of rentiers, wealthy individuals who live off interest income, and the concentration of money in banks. Historical interest rate trends. The provided data demonstrates a long-term decline in interest rates on short-term loans in the U.S. money market. This illustrates the trend mentioned earlier. Forms of credit. Banks and their operations. Two main forms, commercial credit and bankers' credit, facilitate the movement of loan capital. Commercial credit, used by businesses to buy and sell goods, speeding up the turnover of capital. Typically short-term and often involves bills of exchange, debt obligations. Bankers' credit. Banks act as intermediaries, lending out money deposited by others to businesses. This credit can be used for various purposes, including expanding production. Banks' profit mechanism. Banks profit by charging higher interest rates on loans than they pay on deposits. This difference covers their operating expenses and generates profit. Passive operations. Banks attract money through deposits, both fixed-term and on-demand. Active operations. Banks lend out the deposited money, discount bills of exchange, and invest in various enterprises. Types of banks. Commercial banks focus on short-term loans to businesses. Mortgage banks provide long-term loans secured by real estate. Banks of issue have the right to issue banknotes, with central banks playing a key role in managing national currencies and gold reserves. Functions and consequences of banks: speed up capital turnover. Reduce costs of monetary circulation. Facilitate resource allocation between economic sectors. Centralization of capital, squeezing out smaller businesses. Intensified exploitation of workers. Exploitation of depositors through lower interest rates on deposits. Ruin of peasants through mortgage debt. Exacerbated contradictions of capitalism, such as the conflict between social production and private appropriation. Joint stock companies. Fictitious capital. Rise of the joint stock company. While existing since the 17th century, this form of business organization became dominant in the late 19th century. Shares and dividends. Joint stock companies raise capital by issuing shares, which represent ownership in the company. Shareholders receive dividends, a portion of the company's profits. Share pricing. Share prices fluctuate based on factors like dividend payouts and prevailing interest rates. Investors seek higher returns than bank deposits, but also consider the risks involved. Founder's profit. This refers to the difference between the total value of issued shares and the actual capital invested in the company, often enriching the initial capitalists. Dual existence of capital. Joint stock companies create a split between real capital, factories, equipment, etc., and fictitious capital, shares. Shares become tradable securities with a separate existence from the underlying assets. Control and ownership. Illusion of shareholder democracy. While technically governed by shareholder meetings, joint stock companies are often controlled by a small group of large shareholders who hold a controlling interest. Centralization of capital. Joint stock companies facilitate the concentration of capital in the hands of big capitalists who can leverage the resources of smaller investors. Fictitious capital and stock exchanges. Fictitious capital. This refers to capital in the form of securities like shares and bonds, which generate income for their owners. Stock exchanges. These are markets where securities are traded. Share prices are influenced by factors like interest rates, dividends, and speculation. Consequences of speculation. Stock exchange speculation often benefits large capitalists, contributing to further capital concentration and potentially ruining smaller investors. The rise of the rentier class. Shift towards passive income. The prevalence of joint stock companies and credit allows capitalists to increasingly rely on interest and dividends as their primary source of income. Separation of ownership and management. The management of production is delegated to hired managers and directors, further reinforcing the passive and parasitic nature of capitalist ownership. Monetary circulation in capitalist countries. From bimetallism to gold monometallism, early capitalist economies often used both gold and silver as currency. Bimetallism. By the late 19th century, most transitioned to gold monometallism, where gold became the primary standard. Features of gold monometallism. Free minting of gold coins. Individuals could exchange gold for coins and vice versa. Free exchange of other money for gold. This ensured a direct link between gold and other forms of money. Free movement of gold across borders. Gold facilitated international trade and settlements. Self-regulating money supply. Gold monometallism allowed the money supply to adjust based on economic needs. Excess money would be hoarded, while shortages would draw gold back into circulation. International settlements and credit money. Gold as international currency. Gold facilitated payments in international trade. Exchange rates. These determined the value of one currency in terms of another, example, pounds to dollars. Non-gold settlements, clearing arrangements and bills of exchange allowed for international payments without physical gold transfers. Rise of credit money, bills of exchange, banknotes, and checks emerged as common payment methods, reducing reliance on physical money. Banknotes, initially backed by gold, banknotes allowed for a more flexible money supply. Shift to paper money and inflation, decline of gold in circulation. As capitalism developed, gold was increasingly concentrated in central bank reserves, replaced by banknotes and eventually paper money. Inconvertible banknotes. These banknotes were no longer redeemable for gold, making them similar to paper money. Paper money circulation. Since World War I, most capitalist countries have adopted paper money systems, with gold largely absent from circulation. Inflation. Governments' ability to print paper money can lead to inflation, characterized by rising prices, declining real wages, and increased profits for capitalists. Inflation as a tool. Capitalist states may use inflation to gain advantages in international trade or to finance government spending. Monetary reforms and devaluation. Monetary reforms. Governments implement these to stabilize currencies and address economic problems caused by inflation. Devaluation. This involves officially reducing the value of a currency relative to gold or other currencies. It can make exports cheaper and imports more expensive, potentially boosting domestic industries. Social costs of reforms. Monetary reforms often involve austerity measures, such as tax increases and wage cuts, which disproportionately burden the working class.